How John increased his retirement probability by taking on less risk. Shh, don't tell anybody. There's going to be people out there. Thomas P., I'm looking at you. Actually, Thomas P. is all right. A couple other guys on here, my last video, like, I'm just going to invest in stocks. You're not because you're scared. I was like, you're damn right I'm scared. I'll take that as a badge of honor, man. Of course I'm scared about lose my shirt investing. 100%, I'm still in stocks. You know, a third, like my most recent video. Anyway, so my man John emails me, and I always like to help people figure things out on their own. He goes, Josh, I don't get it. I can't remember the exact numbers, but my probability of success went from like, was it 83? I think my mid-80s, something like that. 83 to 95 by reducing the risk. I went from growth to, I think it's conservative. So in my software, growth is 70-30 stocks to bonds. Conservative is 35-65 stocks to bonds. And he went from growth to conservative. He's messing around the right capital. You know, he got the little thing in the retirement analysis. Click on the action items button in the bottom, and it gives you little, slider bars and drop down boxes where you can mess around. And he was messing around. He didn't change it. He just was kind of comparing the two. He said, if I move my portfolio to conservative from growth, why does it give me a better probability of success? All right, so this is a freaking huge deal, man. This is a huge deal. I hope this audio is okay. All right, so on the growth portfolio, I'm giving him like a 5.5% rate of return. I want to say like a 14% standard deviation. On the conservative model, I'm giving him like a 4.5 rate of return with a 10% standard deviation, something like that. I can't remember. All right, but and it wasn't always like that. A year and a half ago, no, a year ago, we weren't giving you 4.5% on conservative. We're giving you about 3.5%. Why? Because the rates were so much lower than they are now. I cannot stress enough, man. Dude, I was the anti-bond guy. You could see all my videos from 3, 4, 5 years ago say, don't invest in bonds. And I was right, because the bond market got skunked, just like I told you it was going to happen. Could it happen again? I don't know. Sure, absolutely. But it's pretty obvious to see that the bond market had only one direction, which was down, because the rates at some point would have to go back up. Anyway, well, now that time is behind us, and we got skunked like we've never been skunked before last year, and so now we're reaping the rewards. So in this case, to reduce his expected rate of return from 5.5 to 4.5 also reduces his standard deviation, which is downside risk, again, from, I can't remember, 15 to 10, something like that. That's a 50% reduction in downside risk, which means if you take the standard deviations, and we'll just use 10, times that by 3 standard deviations, we'd expect within 99.8% of the time, your portfolio return within any given year would fall within 3 standard deviations around the mean, the average. So if our average rate of return is 4.5, and we have a standard deviation of 10, take 10 times 3, that's 30, plus and subtract the 4.5. So in any given year, 99.8% of the time, we'd expect your portfolio to give us roughly 35% on the high and negative 25 on the down, 99.8% of the time. Just for simplicity. A 5% rate is actually 4.5% rate of return, plus or minus 3 standard deviations, which is 30%. I'm just kind of slicing off the 0.5 just for simplicity. So, John, in a conservative portfolio, said I should expect a 4.5% rate of return with a downside risk of 25 and an upside limits of 35, 99.8% of the time. On a growth portfolio, is 5.5% was his expected rate of return with a standard deviation of 15. All right, so 15 times 3, that's 45. On any given year, he would expect he could be up 50.5% or down 39.5%. All right, so we've sliced off the downside from 39 to 25, a significant slicing off the bottom end there. And remember, 2008, the markets were down 37, guys. I can't stress this enough. And you still got to look at October 2007 to March 9th of 2009. 55, I think it's 57% top to bottom. Dude, You're tired of that? Are you retired? Are you retired into that? You think you're like, I can take the risk. I'm not scared. All right, more power to you. You could. No one could. Anyway, the point being is, dude, that's why John's probability of success improved, because we sliced off that, what did I say, 39% downside risk. And I'm just kind of creating the numbers out of air. I don't know the exact, what I use the right capital, but pretty doggone close to 25. All right, so basically that's a 50% higher risk for the growth portfolio than the conservative portfolio, with only losing a 15% rate of return, give or take, 4.5 to 5.5. Now, I told John, I said, what else do you see there? Because I want to answer a question with a question. I want people to figure this out themselves. You know what I'm saying? Because once they figure it out, they take ownership and say, man, I don't need to listen to these crazy guys. I don't even need to listen to Josh anymore. And so when he took ownership, he said, hey, I'm also leaving less money. I said, that's a problem, though. Because there's less upside in the conservative portfolio, you might leave less money to your kids, but you have a higher probability that you won't run out. And that's what you got to contend with. Is it worth it to take less risk to enhance my retirement versus what I leave as a legacy? I think it is. You might not, and that's fine. I got no qualm with that. But if you're taking less risk, there's more upside growth. There's less upside growth. If you're taking less risk, there's less upside growth. There's less downside risk too, but there's less upside growth as well. And again, on average, that 1% over a 30-year retirement can mean a big difference in how much money you leave to your kiddos. So we don't take this lightly. There's no free lunch in this stuff, man. But that's why he was able to increase his portfolio retirement success while taking less risk. It's just that simple. Love your thoughts. We'll see you.